Hello, you are watching Morning Markets on BNN Bloomberg. We've got a lot to unpack today. We've got Andrew McCreath, who's the founder at Forge First Asset Management, joining me as co-host for the next half hour. And I'm glad because we continually get the same thing from the Federal Reserve. I think Jerome Powell is pretty consistent in his messaging, and the markets decide to hear something else, or maybe it's what they don't hear. And we saw a big rally after he spoke yesterday.
We absolutely did, Amber. It's great to be back with you. And, you know, when you look at Powell, I believe, just like Amber said, he told it like he sees it. Yesterday on that interview, and then previously at the press conference last week. And markets did choose to hear what they wanted to hear. And I think equity markets are going to stay very choppy and range bound. I think we're at the higher end of the range right now. But as we look forward, Amber, I believe that inflation is going to stay sticky, growth is going to be lousy, consequently profit margins will be under pressure. And the S&P 500 is now trading at 19 times forward earnings is rich. So I think that, you know, it's going to be chop, chop, chop this year, just like it was last year. And, you know, some folks will get all stoked up because markets are higher, as they had. It was a huge January, but there was a lot of speculative activity in January. For example, almost 45% of all the S&P 500 options that traded during the month of January were single-day options.
Meaning it's fast money.
It's all fast money. It's all speculative behavior. And we know the best performers in January were the worst performers last year.
That's right. I was just going to bring that up. You saw that in the quality of the names. Money-losing tech, the most shorted companies rallied the most. It wasn't, you know, your classic, your high-quality names. Does that bother you when you're looking at a rally and trying to determine if it's sustainable or not?
Absolutely, it bothers me. But what really bothers me is Jerome Powell didn't even reference that, because he talks about not wanting to repeat the mistake of the 70s when the Fed, you know, cut rates and then inflation went back up again. So when you look at him talking about financial conditions, he's arguably facilitating the bubble getting bigger once again.
So then Tiff Macklem must really bother you, because I would say he's going a step further to, you know, he puts in the caveats, the battle's not won on inflation. But I would say yesterday, and when he made his rate decision, basically suggested, you know, we're winning the battle on inflation. We can pause here. Well,
he has to pause. I mean, we have so much leverage in our country. I mean, you look at the debt to personal disposable income ratio in the private sector, it's 186% in Canada, it's 100% in the States. We're very leveraged in this country, of course, to the housing market, as we all know. So he can't keep hiking rates or he's going to cause a problem in the economy. Again, he was a leader in being hawkish, and now he's being a leader in being dovish. But again, the media decided to focus on the fact that he hinted that, you know what, we may be done for now.
Don't shoot the messenger, Andrew.
But he did go on to say that if inflation stays sticky, he will hike rates again.
Yes, but so does the Fed. And this brings up an issue of credibility. Have you ever seen a market so divorced from what the Fed is telling you they're going to do?
Oh, well, no. Of course I have not. However, during the last couple of days, you will note that the market is now pricing out the rate cuts that the market had priced in for the back half of 23 in the United States. You go back 2 weeks ago, there was 50 to 60 basis points, in other words, a little more than 0.5%, priced in Fed futures of rate cuts in the back half of the year, and that is quickly dwindling down towards zero. But the other comment I'd make about the market and reality is liquidity. The market is drunk on the punch bowl. And the punch bowl is still there. And we have a graph to show our viewers. It's not this graph here, but what we're going to show our viewers is a 2-axis graph. And the price of the S&P 500 is going to be on the left axis here, and that is the blue line. You can see that this graph is from March of 21 on the far left side of this graph. So the blue line is the S&P 500. It's on the left vertical axis. The white line is on the right vertical axis. And that is what our team at Forge First considers to be a proxy for central bank liquidity. And for those that want to get a little inside baseball, and what do we mean by that? We're talking about the size of the Fed's balance sheet plus changes in the checking account of the U.S. government, the TGA as it's called, and reverse repos. And you can see the correlation between the two variables is obvious, starkly obvious, except on the far right-hand side.
And so you think it's going to be the S&P that comes to meet that white line lower?
Right, because if you squint hard on the right-hand side, you can see the blue line's gone up and the white line's gone down.
Okay, and now I can push back on everything
Sure.
that you've said with a few comments. We've had a historic increase in interest rates, and the economy globally is proving to be resilient to that.
For now.
You talked about growth stagnating. The Atlanta Fed's GDP Now forecast for the upcoming GDP was revised higher and significantly higher, from 0.7% to 2.1%. The ISM services sector, which saw a brief contraction in December, a sharp upward revision higher. The jobs numbers. This is all happening at a time where inflation, and I get that it's not perfect, but inflation is coming down in some areas of the market. And we're going to talk about a company like Chipotle that is signaling it's reached the limit of how much they can increase prices.
Right.
Most businesses reporting quarterly results this season have said as much. We've reached the limit on how much we can increase prices. Consumers are reacting.
Okay, I got to push back.
Okay, push back.
Right?
But
bottom line is it's known
that
that it takes 9 to 12 months for rate hikes to actually impact the economy. And the majority of the rate hikes during 2022 happened at the back half of the year. I think the economy really slows markedly in the back half of 23, and that's when I think the banks start to have problems with mortgages and credit, and as the mortgages roll over from fixed to floating at much higher rates. So bottom line is there's a big lag.
But then they'll cut rates, and the market will be right that they'll cut rates.
But the second aspect is there's been no winter. Yeah. And you cannot underestimate the impact in the economy about the fact there's been no winter. And actually, I talk about that in my new monthly commentary that I'll post on my website, forgefirst.com, tomorrow morning. But you can't underestimate that, Amber.